and we'll get going. But I just want to start, yeah, it's 10 o'clock now, so thanks everyone for joining. It looks like sound's okay, slides okay. We're just going to put this up very quickly. It's our disclosure here at forex.com that the information and opinions in this webinar, they're for general information use only, and they're not intended as an offer or solicitation with respect to the purchase or sale of any currency or CFD contract. All opinions and information contained in the report are subject to change without notice, and the report has been prepared without the regard of specific investment objectives or the financial situation and needs of any particular recipient who joins this webinar. Remember as well, guys, any reference to historical price movements or levels is informational based only, and we do not represent a warranty that any such movements or levels are likely to reoccur in the future. Let's also take a few other bits on this. Futures, options on futures, foreign exchange and other leverage products, they involve significant risk of loss, and they're not suitable for all investors. Increasing your leverage, remember, increases your risk. Spot gold and silver contracts, they're not subject to regulation under the US Commodities Exchange Act, and contracts for different CFDs, they're not available for US residents because of regulatory reasons. So here we go. So that's the disclosures. Thank you all for bearing with us for that. Let's get to the fun stuff. Just bear with you one moment. Let's put up a new chart. So we have had some interesting goings on in the FX market. I just want to show you what everyone's really been talking about first thing this morning, which has been the Aussie. So what we got was a really nice was a surprise, well, a bit of a surprise rate cut. Funnily enough, we started getting it priced in really yesterday, and since then we've seen a bit of a sharp decline, and the reason why the Aussie move is quite significant is because we've got below that 102.20 level. Now this is just kind of the price movement. I'll just show you kind of price movement today. That is the RBA rate cut. Now we had been at kind of 102.50, we got below there, so it's a 60-point drop. So it's not huge. So it suggests there was some expectation. But it's where we go from here. Now, as you can see, the Aussie, the RBA mentioned the Aussie quite explicitly in their statement, and I think it's all going to be about, well, where possibly can the Aussie go now, and how I'm looking at that, and what's a very good way of kind of looking at this. Let's take a look at this swap rate. So this is just the Aussie swap rate, and as you can see, fallen very, very sharply, just even like this month, just even really in May. I mean, it's been on a downward decline, basically, from here really, from kind of the middle of April. It's been on a very sharp downward path, so there's a lot of expectation of rate cuts in there already, but we could have further to fall, and I think that's going to be the key thing. The key thing is whether or not, right now it seems like the RBA, they're still into rate cut mode, but what we've seen in the past, is that when the Aussie has, when the RBA have tried to cut rates, we've seen them actually kind of be a bit cautious actually on cutting rates. So they cut rates and then they wait. They like to see the digest. They don't cause like a big kerfuffle. However, they are a bit concerned about slowdown of the mining sector. And we're actually going to take a look at commodities. But basically, I think right now, what does this mean for Aussie? I don't think we're going to go off a cliff. I don't think we're going to go all the way back to kind of 96 lows or anything like that anytime soon. But I do think this means for a slow grind lower. If we can stay below 101.80 towards 101.50, then it really opens the way to parity for me, and it's just a matter of time. Now, Ray, good morning to you as well. You said currencies are slow moving this morning, apart from dollar Swiss, which had a nice move up, and we are going to see that. And yes, dollar Swiss had a lovely move up, but they are fairly slow moving, and the main reason for this, of course, is the fact that there was holidays in the UK yesterday. Sorry, just bear with me. I've got a bit of a sore throat. Holidays in the UK yesterday. The markets are just getting back into the swing of it. Also, there's not really been too much economic data to guide us one way or the other. We did have some data out of France earlier. We do have a bit of a Franco-German summit going on. We've had some headlines coming out of the Eurozone. But again, nothing really market moving. And we've got some German factory orders at 11. That's probably going to be more significant for the DAX, which I'll go through in a moment. But let's just take a look at this Swiss move. So this is just dollar Swiss franc. As you can see, it's got up against got through some nice resistance levels. You've obviously had that. We've had that cross in the 50-day, but it's still above the 200-day moving average, which is positive. 94.10, massive level. That is the 50-day moving average, key resistance level in this cross. And if we can get above there, then it really opens the way to these highs here, just before 95, but also to 96. Now, as you can see, just kind of, eyeballing this chart, we've made some higher lows here, which is all very positive, and that nice double bottom there at 92 suggests that is a medium-term low, and we're above these key levels. We would expect a bit of stickiness now around this 94.08 level, but if we can get a close around 90, certainly a daily close above here, that's a very bullish picture for here. And what I think is actually more important isn't necessarily where we are. I think it's much more to do with just to go back to this point. I think where we are right now with the Swiss franc, is it a sign actually, rather than just being a Swiss move? There wasn't any kind of Swiss data. Is it more of a sign of what's going on with the dollar generally? And I say this because obviously on Friday we got that very strong we got much better than expected payrolls number, which again, doesn't suggest the US economy is going great gangbusters or anything like that, but it does suggest that maybe we're getting the US economy, it was just a blip, really, some of that weak data. Jeffrey's mentioned about the S&P foreign exchange reserves. Jeffrey, I will talk about that, but please let me talk about the dollar first, because I believe it's much more of a dollar move. Now, obviously, what the S&P are doing, they're trying to weigh down on the Swissy generally, but particularly against the euro. But actually, what we've seen is the euro start to rise. So I don't really necessarily think this is a Swiss move. I do think it's much more to do with it being a move for the maybe potentially the start of a dollar move. Now, this is what we saw last week, a really nice reversal in the dollar index. We had fallen below that 82 level. Now we're still below 82.50, and that is really key resistance. It's going to be hard. We're going to be hard pressed to get too excited about the dollar if we don't get back above that 82.50 level. Now, this is the dollar index, so it's the dollar against its main trading partners. Today it's been a bit more mixed. Yes, we've seen the dollar gain some strength against the Swissy, but we haven't seen that feed through yet. So what we really need to do is see a more broad-based dollar. Now, there's two two potentially opposing factors weighing on the dollar at the moment. The first thing being, of course, the QE, massive amounts of QE. The fact now that QE in the US may remain ongoing until kind of next year. That the idea of tapering purchases this year is possibly a little bit premature at the moment, but it may happen next year. So we're readjusting to that, which could be dollar negative, but also but then on the other side of that, you have got this better than expected economic, or this, I suppose, recovery data just in the last few days. How do these two things play out? Well, we have obviously got, really nice, in the short term anyway, really nice series of higher lows, but we do need to get back above that 83 level for the dollar to have a broad-based rally, and that's kind of what in the FX market certainly a lot of people have been looking at, and I think, looking at the dollar, the key drivers of the dollar in a positive sense, obviously it's economic data, obviously, better sentiment towards the US relative to elsewhere, and how easy is that going to be to play catch up? We do know in the past that continued liquidity is actually also a good news for things like the euro and commodities and the risky end of FX, and it's not necessarily doing that right now. Now, let me bring up the euro just to see, what that is doing, because right now I think the overall message I think regarding the dollar is that we're a little bit unknown. We're still in the unknown. Now, this is euro. As you can see here, still range trading, still within that range. Not even that rate cut from the ECB could get us out of that range, and it's a very well-defined range. Right now, you've got the 100-day SMA 131.58. We haven't managed really to stay above there. Of course, then we've got this 132.10 level as well, which goes back all the way, over the past nearly month now. And on the downside, there's obviously 130, 130.10 50-day moving average, and then below there, kind of 129.80, which is the 200-day moving average. So it's not unusual for the euro to trade sideways. So you get these kind of moves higher, trade sideways, then another move, then, then a trend, then move sideways. So we could be here for a while. It's not unusual. What are the next key fundamental drivers? If it wasn't kind of the rate cut, and if even the prospect of negative deposit rates, which is essentially, a form of currency devaluation, what is it that will, push the euro lower? And I think, some people do see it kind of defying gravity, really. But you've got to remember as well is that there's a lot of bad news priced into the euro. So I would say the upside is more at risk now, especially if we get some better than expected economic data. Now, we've seen the US pick up after a slight slump. Well, can Germany follow? We've seen Germany follow the US patterns before, or US cycle before, with a little bit of a lag. I think that if we see, because we've seen the core in Europe perform so badly, what could get us above this level here could actually be, could actually be a pickup in Germany if Germany follows suit. So German data is really important, and it's really important to watch things like these factory orders. Now, these factory orders for Germany, they are March data, so it is, it's not as important as, it's not the most recent data. I understand that. We're going to have to wait for another 2 weeks to get the May PMIs for Europe for that, but they are quite. They are worth watching. If we get any positive surprises, and there has been a real lack of positive surprises from Europe recently, then that could be kind of a key thing. There's also, let me just show you just some key levels, really. We've gone back above that cloud as well in euro. What does that mean? It means that we're trading sideways. So this is just purely from a technical perspective. Likewise, let me just bring up the Swissy as well from a more technical perspective for you guys. Again, key resistance here now at 94.38. So Ray, I know you're looking at it. We're still not in an uptrend. If we can get above 94.38, then it does open the way to those 96 highs. So again, above 94.38, which is the top of the daily Ichimoku cloud, in a very basic way of looking at these Ichimokus and how they can affect your trading, especially for a discretionary trader, which I'm assuming most of you are. It's about jumping above that. That 94.38, that would be a very bullish development. It may attract some buying interest there as well. So do watch out for that. Now the other thing I wanted to show you was actually, I'm going to do a bit of swap and start, really. The DAX. So for those of you well versed in the DAX, it's the German index. So we're right now testing a really important level, 8149 level. That is a record high. So we've actually been to a new record high, 8160 now. But we basically reached a record high, yes, a record intraday high yesterday. Record intraday high yesterday, and if we can move higher, that's we're breaking fresh ground. Let's take a look at this. This is the max chart for the DAX. Just bear with me 1 minute. As you can see, fresh record high, nice push higher there, and the fact that we've managed to continue today as well is obviously very significant. Obviously, a lot of people at this point is it actually time to urge caution? Well, it's interesting because let me just zoom in on this. When you get to these kind of big levels, you've got to weigh things up. On the one hand, yes, we've seen kind of the core economies just start to show, especially Germany, start to show some worrying signs of slowing down. Why is the DAX at this high level? Well, because we're being met with a wall of liquidity. QE3 is likely to be extended out even further, and the ECB has cut rates, the RBA has cut rates. We're in a long-term era of very, very cheap money, and that's good news for Germany because it's not like in Spain or in Portugal or anywhere like that where even the rate cut isn't actually having an impact because the banks really aren't passing those rate cuts along. What we're seeing in Germany is that that rate cut last Thursday has been passed on. So what we're, this is that rate cut is probably better news for somewhere like the DAX than it is for something like the IBEX. And in fact, I'm just going to compose a chart like that. And those of you with Bloomberg terminals will see this, but I know a lot of you don't. But it's very, very easy to compose a chart using Bloomberg, and it actually takes out a lot of Let's just finish that there so you can see this. So as you can see here, yeah, the DAX is the white line, the IBEX is the orange line. Well, the IBEX is still at very high levels and has moved higher. DAX has outpaced those gains. And if we just go to the max level, you can really see the difference here. With the IBEX nowhere near its record high that it was, that we reached for the IBEX. I think the record high was back in kind of 2007, I think. Yeah, 2007. Instead, what we're seeing is, the IBEX, yes, it's moving in the same direction, but they're completely different contexts. And for, and that's completely right. Okay, there's not as much, or there's a good justification for that, I should say, that there's not as much kind of good news around, or not as much potential really for the rate cut, number one, to have an impact on the Aussie, on the Spanish economy, and number two, the Spanish economy is still very, very weak, and the German economy could potentially benefit from strength in somewhere like the US, because obviously it's such a big exporter. Right. So the DAX. So let's just go back to the DAX really quickly, because I just want to go through a couple of things. Just want to extend this a little bit, just to show you, what we're thinking now. Yes, Friday saw a big push higher here. That's that nice white candlesticks. So Ahmed has just said, does the rise of the DAX mean people are investing in the stock market? Absolutely, yeah. So there's more buyers and sellers, that's why it's moving up, and it's just reached record highs, Ahmed. So that's the big news about the DAX. Fresh record highs, it's at all-time highs. So, people are investing in stock markets, yes, but they might be a bit cautious. So just bear with me for this little bit here. Now this white candlestick, big long white candlestick here, followed by a blue one, which is a negative candlestick. So that means that we close lower than what we opened. These are just daily candlesticks here. That is called a bearish Harami pattern. And what it means is that it can sometimes be the sign of a reversal, really, of a future bearish trend that potentially we're putting in a top. Now, obviously then you could say, well, hey, we're higher today, and that's one of the real good lessons of looking at candle patterns. They don't always give you accurate signals. In fact, they're difficult things to trade off because they're not so accurate. People read them in different ways, etc., etc. So what I would say here is that we have seen even though we've seen this bearish Harami pattern, and yet it's been kind of invalidated because obviously we moved higher today. I do think just take heed of it, because it can mean that investors are getting a little bit nervous, a little bit worried at these high levels. Added to that, I want to draw your attention as well to this a bar chart down here, which is the volume chart. So it's the volume of trading on the DAX, and because the DAX is traded on an exchange, you can get volume information. Obviously, those of you who are longer term FX traders know the frustration sometimes of the fact that we don't have the same type of thing here in the FX markets, but we do for the DAX. So let's look at it. Yesterday, so the 6th of May here, volume very, very low. Now the reason why, of course, was that Japan and the UK were out on holiday, public holiday yesterday. So why we could be seeing this kind of move higher in today could also be a bit of catch up. What with the UK being back on board, some people seeing this record high, maybe some fund managers having to boost their proportion of DAX in their funds, etc., etc. But I'm still wary of this bearish Harami pattern, because I still think when you get to these record highs, what we've seen with things like the S&P, they become very, very sticky. And I'm not necessarily saying that oh goodness, all of a sudden we're going to have a reversal. I don't think that at all. But you know what? A pullback to the 8100 level, 8105, I think that's going to be where we're going to attract new buyers. I don't think we're getting real buyers kind of coming in around about 8150, maybe even higher, because they are fresh record highs. People will be nervous. People love a bargain as well. Let's not forget that. There's no difference and that's, absolutely the case in the market. So looking for a pullback, and I think that's what this bearish Harami pattern tells you. As with all candle patterns, always be careful with them. Don't trust them as gold dust. But what it tells me is that there's going to be a bit of profit taking. It's going to be a bit sticky from here, and maybe people will not be extending their longs in the DAX until we kind of get those kind of pullbacks, even small pullbacks. Pullbacks could be very shallow, like we've seen with the S&P 500. Let me bring up the other chart with that. So let me pull up the SPX. This is oh, sorry, that's incorrect. This is the SPX 500. As you can see, it's made record highs, nice move higher, but it has got a bit stuck sometimes at these record high levels. It made that previous record high in mid-April, it then fell back a bit and then moved higher again and broke fresh ground. So, the breaking of the fresh ground there on Friday was obviously on the back of the better than expected payrolls number. Well, that's potentially what we may need with the DAX is some type of fundamental reason to push it forward. Right now, though, I mean, there is this central bank wall of liquidity, and this is an established trend. So, don't necessarily go against it. People like investing in established trends, and that's why stocks have continued to be very, very successful. Let's just go back to the 1-year chart. As you can see, you don't get more established than this, really. So I'm not saying that people are going to come out of the DAX. I'm just saying be wary. If you are interested in a long position, it may be more expedient to wait for a bit of a pullback. Now, the other thing I want to show you is commodities. Now, in the past, stocks and commodities, or what I should say is that commodities in the past have also been sensitive to these walls of liquidity coming from central banks. However, that may not necessarily be the case right now. This is the overall index. And we've actually seen stocks and commodities diverge. Interestingly enough, commodities have diverged even though interest rates are really low. So this is just this is a bit of a messed up chart, actually. Let me just look at the year-to-date one. As you can see, yes, we've recovered a little bit just in the last kind of month, but we are hitting a bit of resistance there. There is some divergence going on as well. I just want to show you silver because I find silver quite interesting. Silver is a precious metal, but it's also an industrial metal. So you'd think, hang on a minute, the US is picking up. Surely silver should do well. Well, it didn't, which makes me just a little bit concerned that, yes, stocks are this, this more kind of established trend, but it doesn't look to me like, commodities are going to be joining it anytime soon. And that's usually typically the case, right? If you look at Intermarket Analysis by John Murphy, he's like the bond market moves first, then that impacts commodities and the dollar, and then that hits the stock market. Except what we're seeing now is that bonds are being kept artificially low by central bankers. Stocks and commodities are going in opposite directions. So what does it mean? Is it, are commodity investors a little bit more savvy than equity investors? Are they looking just beyond that, that wall of money and saying, well, that can't last forever. We don't think that's good. We don't know. I mean, I'd be naive to mention it. All I can do is what I'm saying right now is that, silver is still very, very bearish on that. As you can see, series of lower lows. That's your typical level. It looks like we've got a bear flag forming, and that if we fall below kind of 2350-ish, that could open the way back to a retest of 22, which is a key support level there. That low, we did get to it in mid-April, but it's held as very good support of late. But if we go back even further, obviously, there's a long way down below this 22 level, but still, still looking bearish on silver. What about something like Brent? Let's take a look at Brent. Brent is a big component, by the way, of that CRY index. So as you can see, yeah, similar-ish. Brent, this is Brent, isn't it? Yeah, CR1, I'm pretty certain it is, yeah. Yes. Sorry about that, just double checking, because obviously you've got the US oil as well. As you can see, we did have a bit of, at the beginning of this month, a bit of a drop below 100, but we had a quick reversal from there and since then have moved higher. But there is some key resistance there at 106.39. I think on the longer term basis, what is going on with, what are the drivers of oil? The drivers of oil, obviously supply demand fundamentals. We know for a fact that OPEC doesn't like oil below 100, and indeed we said that, we pointed that out last week, and indeed it's moved higher. Where does it go above 106.39? I'm not 100% sure there's the push for it to move higher. I'm not sure you're going to see people just kind of all of a sudden getting out of equities and moving into commodities because this looks like a nice move higher. I don't think the technical basis is there for it. I don't even think the fundamental basis is there for it, especially in something like Brent, which is usually considered European oil, and we know that in Europe the economic outlook is quite weak. In the US, there's a bit of a difference. Yes, the economic outlook is brighter, but there's an awful lot of supply coming onto the market now that the US is pumping its own oil. So So again, these kind of diverging influences or conflicting influences, if you like, on commodities generally. We're currently trading up just above 105. I think 106.40 is probably going to be the high there in the short term anyway for Brent, which is the 50-day moving average, so a key resistance level. But definitely worth keeping your eye on Brent. I think if it gets above there, I would be a bit shocked. But it would open the way for a move back towards 110. So do watch that. Now, I do also want to just quickly go through dollar yen, just to give you a bit of an update on the dollar yen continuing saga on dollar yen. Sorry, that's not dollar yen, that's CAD yen. This is the hourly chart. As you can see, getting stuck here about 94.20, which is the 50-hour moving average. And as you can see there, yeah, I mean, following the slight bias lower, not being able to get above this kind of 99.50 level. We need to get above there to get us to 100, but just to kind of go back to yen here, people have said, like, where is what happens after 100? We would argue, actually, you've got to go all the way to the monthly. We would actually say this 120 level is really, really massive. The top of the monthly Ichimoku cloud, that's when you change. I mean, we're hesitating, and we've hesitated here for a while. If we get back above there, then it could easily see us to, the more longer term outlook then is 110, potentially even 120, which I know a lot of people are looking at. I tend to not think it's as easy as that, and that's why I tend to think that, we could be stalling around here just for, at least until we get some more fundamental news, which is not going to be likely this week. So I don't see this as being the big thing. But again, dips are shallow, so dips back towards 97.50, even just below 97, are being snapped up. So Pan has just said, how do you see the interest rate cut affecting the Aussie? Is it normal to expect continuation in European session? Yes, I think it is. Sometimes it is, yeah. So let's just pull up the Aussie again. But I think, that move below 102.20, which was the key resistance level, support level, from, basically, since February really, that's an important move, and that would trigger some extra selling interest. RBA rate cuts, do they usually? Sometimes they will have a bigger impact if there's nothing going on during the European session, and right now we don't have too much going on in the European session. Economic data is fairly thin on the ground today, and yes, there are different summits and things like that, but we've basically got the UK coming back from holiday mode, and so things could be a little bit slow. So they're just going to be digesting it, but it's a bit like the chart I showed you at the top. There's an awful lot of rate cut expectations priced in for the Aussie right now. So what we may need to see is yes, I think the Aussie is one of certainly is the weak currency across a lot of currencies. But if we just look at, let's pull up my other chart. What I think we need right now is, I think there's going to be a bit of hesitation really between kind of 101.50, 101.70ish. If you get below there, then I think it really opens the way to parity. But I think people are going to be saying, okay, fine, right. So they might make up once more this year, but really they are a very reactive central bank. But we have, and they are a reactive central bank. For the Aussie, rate cuts are only, yield is one part of the equation with Aussie. Certainly the yield differential hasn't held it up against things like the US dollar recently. It cut right through those resistance zones. Let's look at Euro Aussie as well. Euro Aussie, we're testing this real high here. If we get above kind of 101.28, well, we're on 28.90. A daily close above there is very bullish, maybe for even a return to these 132 highs. There are, let's look at the Pan. I'm just trying to answer your question, and I'm not sure I'm doing a great job at it. But what I'm saying is, usually how it follows is that what happens in Asia in the Aussie session doesn't really follow into the European one, but sometimes it can if there's not too much going on in the European session. So I think people will be thinking about the Aussie. They may look to short it on on a period of strength, maybe back up towards 220. Basically, there is expectations of a rate cut now. So that is of future rate cuts. There's the potential, of course, that the mining boom actually is more severe than expected. So I think going forward, I would say that right now the Aussie may be, it may be done around this level. I just want to also bring up my other chart. Just put Aussie here, just to show you what momentum is really thinking. I'm also going to pull up my other chart. So as you can see, momentum very, very weak. Very much on the downside. We are kind of flattening out a little bit, which is completely normal. This is on the daily. Let's take a look at the hourly. Yeah, very much like, looking pretty oversold right now. So we would expect potentially a bit of a pullback, maybe towards those 102.20 levels. But we still see kind of the bias being lower for the Aussie. But we think it's going to be driven lower by fundamental factors. Weak economic data, for example, is going to really just light those fires, get people really thinking that the RBA is going to, it's got a lot of room to cut. So if we see weak economic data, or if we see that mining sector boom slow much faster than expected, which some people are expecting now, if we see that in the real economic data, then that could have a big impact on the Aussie, and we could see it well below parity, and maybe even, sorry, this is a bit, let's go back here. As you can see, this is Euro Aussie. Let's go back to Aussie. Back towards parity, back towards kind of parity, which is this June low. So, we've crossed it. We've crossed a Rubicon, if you like, and that's important. Tommy's asked about dollar CAD. Dollar CAD's been really interesting, Tommy, because not only have we had, we've actually had kind of some. This is dollar versus CAD, by the way. So we've had two things. So the Canadian dollar does really well in the US when the US economy is doing well, and we've seen that pick up in the Brent crude oil prices. So that's been good news for the CAD, and we've seen dollar CAD actually fall back below 101, which is a really, quite a bearish development. We got through that kind of 100.88, which was the 100-day moving average, and then we have very good support here, the 200-day moving average on, which is just below parity there. I think kind of, going forward, I think we're going to have to see, we've had a bit of congestion now, so the market's really kind of taking their time. I do think that break below 100.80, if we can stay below there, I think that is, quite a bearish development that could see us to parity. In terms of economic data out of Canada, because that will also be key as well, I think it's going to be, there obviously is like some employment data and housing data this week, which is certainly worth looking at. That's the 10th, so today's the 7th. So that would be on Thursday. That's going to be, that's going to be important. We know that the Canadian dollar is very sensitive to changes in employment there. So that's like the Canadian version of US payrolls. But overall, right now, if crude, as I said, if crude gets thwarted at that level that I mentioned, the kind of 106.50 level, which was the 100-day moving average, then what we could do is just see the CAD struggle a little bit. But overall, I don't necessarily see dollar CAD, rising back up to those kind of 103-ish highs anytime soon. I don't think the situation's there. I think, if we can manage to, stay roughly, if crude can stay, at fairly elevated levels. Likewise, people are going to be looking at the CAD and maybe thinking, hang on a minute, if things are changing in the US and we don't need to be so worried, but yet there is also this QE going on, that's very good news for Canada, and it could also thwart dollar gains, so we could see back to parity. But going below there, I'm not 100% sure. I think there may be 50 or 60 extra pips left. I think it's a bit uncertain right now. I'm going to wait for that Thursday data to make my mind up on CAD. So I think it's one to be patient on. There's also cable. So as you can see here, 150. So really nice move higher in cable, But we have again run into this just wall of resistance above 156. Haven't been able to get above it, but we are managing to stay. We're testing actually really key support here, which is the 50-day, 100-day moving average, which is the green line on this chart here. Comes down at 155.40. If you go back there, it does kind of open the way for this move towards kind of, maybe like back towards kind of 155, even slightly bit lower. But overall, I think, cable right now is just taking a breather. We also have the Bank of England on Thursday. Remember, it was a week later than usual for May. And then the week after that, we have the inflation report, and then the week and Bank of England minutes. So I think this week is all going to be kind of about taking stock really in the pound, waiting for that waiting for that Bank of England meeting. I see it really being jostled around with which way the Aussie with which way the US dollar goes. If we get the dollar above 156, if we get a kind of a weak dollar, then we could get above 156. But likewise, if the dollar if the dollar strength that we've seen against the Swissy starts feeding through elsewhere, then we could get below kind of 153.40, maybe back to 155.40, maybe back towards those kind of 155, 154.50 lows. So that's kind of the key thing there. And Ray, has just pointed out the dollar Swissy. So again, definitely worth keeping your eye on. As I said, 90. Let's just go back to Swissy. Let's end on that note here. Just that level I mentioned to you, which has just slipped my mind really, really quickly. Just want to get it back. Again, look at this. See, we're testing it now. This is the 94.40 level. So again, if we get above Swissy, that's a very bullish development. We haven't really managed to stay above the cloud for very long, or for long periods of time over the last month. But we are going to be watching that pretty closely. Okay, everyone. I'm going to go now. Thank you so much for joining. I'm over my allotted space, so I do apologise with that. Thank you all for joining. Please do join us next week for more, and we will. Good luck trading this week. Again, lots to digest, lots going on. So thank you so much. Okay, everyone. Bye bye.